So hi everyone. In our previous video, we spoke about dividend investing. We spoke about the basics of what a dividend investing is. In this video, which is part two of the series, we'll talk about how to find the best dividend stocks and build a strong portfolio. We'll talk about some of the key metrics that have to be considered to build a dividend portfolio. So let's get into details. So the first and foremost key metric to consider is dividend yield. So what is a dividend yield? Let's say a stock is trading at 100 rupees and you purchase it at 100 rupees. And let's say if the company pays a dividend of 5 rupees, then your dividend yield is 5%. So basically, the purchase price of your stock and then the dividend that's been paid is the percentage. So this is similar to what your interest rate in FD. You invest 1 lakh in FD, you get 5,000 rupees as interest. Your interest rate is 5%. Similarly, your dividend yield is a formula where the amount of dividend paid per share divided by the stock price into 100. So ideally, we should choose companies with dividend yield in the range of 2 to 6%. So very high yields may be a little risky. uh, Companies like HDFC have a dividend yield less than 2%, but though it is low, it is a very, very stable company which can be considered in your portfolio for super long term. So another example, bad example is Vodafone Idea. It does not pay dividends due to financial struggles. So a dividend yield is one of the most important metric that you have to look. How much like FD interest rate, how much yield you are getting is very, very important. So the second metric that you have to look at is dividend payout ratio. So how much of the profit is getting paid out as dividend. Let's say a company is making 100 crore as profit, and if it shares 50 crore of its profit as dividend and distributes it, then the dividend payout ratio is 50%. So basically, it is the total dividend paid divided by net profit or the dividend per share divided by earnings per share. So anything below 60% is a good number. So anything too high may signal that it is unsustainable. It could be unsustainable, or the other reason is it could be unable to grow. Some companies may not be able to grow. They have to simply keep sharing, distributing all of that money as dividend. Let's consider an example here. So this is Castrol. If you look at Castrol, look at its dividend payout ratio. So 68% was there in December 2013. Though it is consistently paying dividends every year, it is not able to grow. In 2013, 3,200 crore. Now in 2020, you can see 2,997 crore. Only in the last few years, it has been able to grow reasonably. Whereas if you look at the dividend payout ratio, 93, 72, 79, 86, 139. So two reasons. One, they do not need this profit because they don't need any additional capital investment to grow their business. So some companies will not be able to grow at all, like how it happened with Castrol in 2020, 2019. So these 10 years, there was kind of very, very low growth. So in these situations, you will see 100% dividend payout and then the dividend payout coming down. So any company that is unable to grow further will pay very high dividend payout. You can avoid such companies in the long run. So Infosys has a healthy payout ratio of 50%. So it retains some money to grow their business to increase their revenues. So a company like Castrol or ONGC has a high dividend payout ratio. It may affect future dividends because they may not be able to pay the same amount every year. So dividend payout ratio is another metric you have to consider. So again, it is very, very simple. In the US, you'll see a lot of people, normal people who would keep investing in dividend stocks and build a dividend portfolio, which is not actually followed much in India. So that is the purpose of this video and the reason for coming up with multiple videos in the series. So the next metric is dividend growth rate. Let's look at dividends. Let's say a company has paid 100 rupees last year and is paying 110 rupees now. Then the growth rate is 10%. So you should also look at companies that can increase the dividend payment. So you should have at least 5 years of steady growth. So if you look at TCS, it has been increasing dividends for the last 10 plus years. Every year, the dividend amount will keep increasing. Coal India did not have revenue growth. In fact, it added revenue degrowth in 2020, because of which it did not pay dividends in 2020, which is not a good sign. The last thing is free cash flow. Uh, Net profit is a number that is presented in the income statement, whereas cash flow is the real cash flow that comes into the business's account. So the higher free cash flow is there, the safer your dividend payment is. So a company like ITC generates a very, very strong free cash flow because it is a high ROE business, very low capital needed to keep manufacturing tobacco. So they have very strong cash flow, and they'll keep paying reliable dividends which are safer and stronger. Whereas a company like Tata Steel is cyclical. So in times of poor cash flows due to market swings, they may not be able to pay dividends. So these companies can be avoided in your portfolio. The next one is a dividend coverage ratio. So what is dividend coverage ratio? How much money do they have to cover? So this is basically the reverse of dividend payout ratio. So your EPS, earnings per share, divided by dividend per share. So if it is close to 1, the company may be struggling to pay dividends. A company like HUL has a strong dividend coverage ratio. It means that you will surely get dividends every year. Whereas a company like SBI Cards is not having a proper dividend payment history because its cash flows are fluctuating. So in the uh, next video, we'll talk about red flags around dividend stocks and how to choose them. Thank you for watching this. Please subscribe to my channel. If you like this video, please like this as well. Thank you.